simple definition of sustainability is the idea of meeting the needs of the current generation without compromising the needs of future generations to meet their needs. As a concept, sustainability is embedded in systems thinking, which recognizes the interplay between the market system, the social system, and the biophysical system. Additionally, sustainability can also be considered at different levels or scales. So at the planetary level, at the country level, at the community level, as well as at a firm or business level, or even at a personal individual level. Within the context of finance, sustainable financial activities are really those activities that intentionally consider environmental, social, and governance issues in the manufacturing or delivery of a financial good or service. So it's important to recognize at the get-go that the financial services sector is one of the most heavily regulated sectors of the economy. Typically, all market regulation aims to achieve three things. One is to ensure that the market system remains stable. Two, to ensure that market participants are properly protected. And three, to ensure that market price signals are efficiently being heard. So what's curious about the sustainability topic is that it touches on all three of those things. So for example, regulators are trying to ensure that the outside or exogenous market risks of a changing climate those risks are clearly visible within the market and are pushing for greater transparency on that level. In terms of protecting market participants, what we see is there's a growing appetite by market participants for products and services that have sustainability attributes, but with that also comes a growth in greenwashing. And so regulators are trying to ensure that products and services that have these attributes are indeed delivering them. And then the third part of it is to ensure that markets' price signals are effectively making their way into the market. And in respect of that, we say growing regulation around the pricing of externalities, and that includes, for example, a carbon price. So we can see that there is growing regulatory appetite globally and specifically within the EU to direct economic growth towards a path that is low carbon, resource efficient, and socially inclusive. So it's important for investors to recognize that the green economy transition is driven by four fundamental drivers, the first of which is the growing scientific recognition of long-term biophysical system risks. The second is a growing consumer appetite for products and services with the sustainability attributes. The third is a on-the-ground economic competitiveness by businesses with sustainable practices. And the fourth is a growing amount of regulation driving towards a long-run growth path that is low carbon, resource efficient, and socially inclusive. I think what investors will need to recognize is that the transition will not be smooth. It's likely to be volatile, and it will take time. It will also have an impact on the historical risk and return profile of different asset classes, in different sectors, and different geographies. And as a consequence, investors will need to be very aware that simply because a product is labeled as green or sustainable, it doesn't necessarily mean it will deliver superior returns. As a consequence, investors will need to be well guided and supported in their investment decisions around the green economy transition.